Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, November 6, 2009. It's 11:30 a.m. Eastern Standard Time in the U.S. It's 4:30 p.m. in London, 10:30 a.m. in Mexico City. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. In the United States, yesterday afternoon, a tragedy unfolded down at Fort Hood, Texas, the biggest military base in the world. A U.S. Army psychiatrist apparently shot and killed 13 former service members. He, at last report, is still living. Apparently, he was concerned because he was soon due to be shipped to Afghanistan. And in the United States, about half an hour ago, down in Lower Manhattan, the New York Yankees have begun a parade down the coming up Wall Street from the Battery to City Hall. So if you're in that area of the world, you know what I'm talking about. We'll get to the news now. In the U.S., the unemployment rate has surpassed 10% for the first time since 1983, and it's likely to go even higher. Nearly 16 million people can't find jobs, even though the worst recession since the Great Depression is apparently over. The government this morning said that the economy dropped another 190,000 jobs in October. This is less than it lost in September, when they lost 219,000. But it's the 22nd straight month that the American economy has shed jobs. It's the longest on record, dating back 70 years. If you count those who have settled for part-time jobs or have stopped looking for work altogether, some experts think that the unemployment rate could be as high as 17.5%. That would be pretty high. We're getting a whole spate of insurance and reinsurance numbers in. We'll go with AIG first. They've posted their second consecutive profit in the third quarter, largely driven by asset write-ups, not write-downs, write-ups, while its core insurance operation continues to struggle. Despite beating the estimates of analysts, AIG stock is down about 6% right now. Actually, down about 3.5% right now. The stock has been up six-fold from an all-time low in March. The AIG CEO, Bob Benmosh, said that the AIG numbers continue to reflect stabilization, but he warns that continued volatility in reporting results in the coming quarters will be related to ongoing restructuring activities. One upcoming expense will be about a $5 billion charge in the fourth quarter as the company closes on the special purpose vehicles connected to its foreign life insurance businesses, AIA and Alico, to pay off $25 billion of its debt to the New York Federal Reserve. AIG is now down to about $120 billion at the beginning of September that it owes out of $182 billion initially. The mortgage, credit, and stock markets have all picked up this year. That's helped the AIG write-up. Despite drastic improvements, analysts have pointed out that the company remains weak. They posted a profit of $455 million compared with a year earlier loss of $24.5 billion. The latest results included $1.8 billion in capital losses. At the same time last year, they lost $15+ billion in capital losses. Operating income at AIG's general insurance business rose more than 6 times as net premiums written fell 13%. Combined ratio climbed all the way up to 105%. Last month, AIG sold its investment company, Primus Financial, for $2.15 billion. The company will book a $1.4 billion fourth quarter loss on the sale. Now all the way to Trieste, Italy, Generali, Europe's third largest insurer by market cap, reported an 86% surge in third quarter net profit, fueled by reduced impairments and higher gross premium income. It said it expects to generate a higher full-year net profit compared to the 861 million euros that it posted in 2008. Net profit for the latest quarter was 390 million euros, up from 210 million euros a year earlier. Non-life operating income fell 28%. Financial segment operating results in the first quarter almost tripled to 120 million euros from 46 million euros, thanks to the positive performance of financial analysts. Some analysts say that the non-life business could suffer from the global recession, especially in non-motor operations. And in Bermuda, Richard Brindle, the CEO of Lancashire, said that he's going to return more than $400 million U.S. to shareholders through a special dividend and share buybacks. This is after low cat losses. The FT is reporting this. Brindle said that the decision does not signal that more limited opportunities lay ahead. He just said, quote, "This is about us returning good profits after we did not return any capital last year. It doesn't show that we have a negative outlook on our markets." In fact, Brindle expects premium rates in Lancashire's markets to be broadly neutral, with some rise in U.S. cat rates. Lancashire's third quarter new business was up 15.5% at $120 million U.S. And then weighing in with the big one, Munich Re, here's their headquarters in Munich. They achieved a consolidated profit for the third quarter of £584 million compared to £1.8 billion for the same period last year. That's a big difference. Munich now expects a group profit for 2009 of between £2 billion and £2.2 billion, at least £620 million more than last year. Total premium income across all lines showed growth of about 6% from January to September. In the life segment, total premium income rose to $5.1 billion since January, compared to $4.5 billion for the same time last year. Munich Re's CFO, George Schneider, said, "We've continued to gear our operations resolutely to profitability. Our shareholders are glad to rely on this continuity from Munich Re." He said, "If the rest of 2009 goes so well, we may even reach our target of a return on risk-adjusted capital of 15% after tax." From your lips to God's ears, Mr. Schneider, that would be quite an achievement. And in Bermuda, Validus said that their net income has risen to just shy of $500 million U.S., compared with a net loss of $126 million for the period last year. Net income for the first 9 months of the year was $732 million, compared with $16 million this year, same time last year. Validus' CEO said, "We completed the IPC amalgamation on September 4th of 2009, and as a consequence of that acquisition, the financial results for Validus Re and Talbot have closed the quarter with total shareholders' equity of about $3.97 billion U.S., assets of $7 billion, and total investments in cash of $5.7 billion. He said, "Looking toward 2010, we approach the January renewal season with over $4 billion of capital and the ability and intent to support our clients with our expanded resources." Their combined ratio was 66.7%. It's pretty darn good. And back to Germany, Hanover Re has reported a group net income of about $860 million U.S., 578 million euros for the first 9 months of the year. In the first 9 months of last year, they lost 143 million euros. It continues to predict a return on equity for the full year of as much as 20%. Gross written premiums rose about 26%. Net premiums were up 30%. Non-life gross written premiums were up 16% for the first 9 months, and during the same period, life and health GWP rose 41%. And net investment income doubled up to 433.5 million euros. So they did very well as well. Back to Bermuda, AWACS, Allied World, they've come in with record 3-month operating income. They've increased their quarterly dividend by 11%. Net income for the quarter was $200 million versus a loss of $46 million last year. 9-month net income was $445 million, up from $164 million last year. It took in a 39% hike in third quarter operating income, best in the company's history. It's up to $155 million. Congratulations to Scott Carmelini down there. Combined ratio even improved 19.8 points, dropped down to 70%. That's also very good. Stock market is down now about 1.59 points, less than 2 points, which is pretty good considering the jobless numbers. We'll go to a word from our sponsors.